In terms of the entire bear market, it would be unusual for it to bottom out anywhere near this high. I would expect that by the low, that the S&P would have declined by 50% from the peak in real terms. So a year from now, when the bear market might end, the trend line value would be almost 3,000 on the S&P. Of course, there's no rule that says you stop at fair value. But typically, in previous big bubbles breaking, they go down below that. That's a lot of pain. And it's possible that would do that again. But you do have to adjust for inflation. There was very little inflation around in 2000. But this time, with inflation running at 8 or 9, it does move the nominal value of the S&P upwards, and one shouldn't lose sight of that. It's hard in a bull market to get your brain around what happens in a bear market. Let me go back to Amazon. Amazon in the 2000 bust didn't just come down. As its sales continued to grow, of course, in those days, it didn't have earnings because it was running on borrowed resources. It came down 92%, with strongly rising sales. A brilliant, successful new idea that went on to own the world and be worth a fortune. How is it possible it came down 90%, 92? So think about that sometimes as you go to bed. I like to say 80% of the time the market is pretty sensible and doing a possibly good job of estimating value for all the companies. A little under 15% of the time, it gets carried away with optimism. And by the end of that time, has nothing to do with actual earnings. It's all in the head, projecting out hundreds of years into the future, assuming that perfect conditions will stay perfect forever. Every bubble takes place with near perfect conditions and huge profit margins. And the market runs with that and assumes it will stay there forever. And of course, conditions mean revert, profit margins mean revert, and good times become bad times. And that is a problem. No, I expect the Fed to be behind the curve, to be deep into optimism, and it doesn't really have a clue about market bubbles and the damage they do when they break. They've been eager now since early Greenspan to encourage bull markets because they help the economy, they really do. And they always forget that the bear markets to go along with them hurt the economy at just the wrong time. So if I'd been asked to bet, would the Fed get inflation wrong when inflation came along at any time, I would have said, of course, they'll miss it, they'll be late, their responses will be pretty ill-judged. The Fed's record is terrible. What is impressive is how much room they have been cut by the market. I mean, the market is incredibly forgiving to the Fed. This Fed had a wonderful environment. They did nothing right, but they were seen to be presiding over low inflation and decent growth. The growth rate actually has slowed way down since Greenspan. It was averaging 3.5 before Greenspan and averaging 2.5 afterwards, and today more like 1.5. It's done nothing in terms of increasing the growth rate, but superficially, it felt like a golden age because asset prices went up. Asset prices went up because inflation came down and rates were allowed to come down. And in the end, rates were forced down. And low rates make leverage cheap, make private equity deals wonderfully easy and profitable, and they push up the price of real estate and they push up the price of stocks. And that's the way it was. And the Fed gets credit for that, and it's due none. Its demerit accrues from the fact that it kept on pushing down interest rates far too long and dangerously, increasing inequality, which, as I like to say, is the greatest poison in the system these days. And it does damage the degree of inequality we have in the US now, does damage the strength of the economy. And it is probably part of the reason why the growth rate has slowed and continues to slow.
There's a lot of concern that we're entering into a 1970s or 80s scenario of stagflation. As a historian, could you give our audience an idea of what was happening during that period and how it resembles today?
Well, every period is unique. The 70s had problems with the oil crises. You can call it one giant crisis, or you can call it two or three. But in any case, it tripled, quadrupled, quintupled the price of oil in a hurry. We'd come off 50 years of fairly stable, low prices, and they shot up and stayed up for a long time and inflicted enormous pain on the system. They lowered the growth rate. Why wouldn't it? If you have to pay 3-4 times for your energy, it also, of course, pushes up the price. So there's nothing like an oil price increase to increase stagflation, and it did. And this time, if you adjust for the passage of time, the price of oil is not as high, but it's still multiplied recently by 3 times. So that is imposing pain on consumption and is imposing inflationary pressure. We also have, because of the invasion of Ukraine, we have had some extra spikes in the price of food, fertilizer, and natural gas, particularly in Europe. Interestingly, they are now, almost all of them, lower in price than the day before the invasion. And this is a lovely example of how the stock market works. The stock market is saying, whoops, there's so much damage from commodity price rises, et cetera, that we're going to have a recession. But the recession isn't bad news, because the recession is going to get the Fed back in our camp of lowering interest rates again and helping stock prices. And we're looking out into the future, and therefore that's a good news. So the fear of a recession becomes a wishful thinking about future interest rates. And so the market gets a reprieve for a while. It's quite remarkable, but it's fairly typical. And that's what we're having now. And that's why we might have a bit of a rally for a few weeks, I think. I think in the longer term, forget the next few quarters, who knows what happens really. But in the longer term, we are really running the risk that this is back to the 70s. We have problems with the availability of plentiful, cheap resources. We have problems with plentiful, cheap labor. The birth rate has crunched in every developed country except Israel and China. That's a very, very important segment of the global economy, to say the least. And every one of them has a population growth rate lower than replacement level. So in the end, after accumulating lots of older people as a higher and higher percentage, we start to actually have the population drop. Secondly, we're 10 and 20 years in, depending on the country, into having smaller baby cohorts. So we know with absolute certainty, since they're alive already, that 20-year-olds arriving in the marketplace will be fewer and fewer for the next 20 years. And we have not experienced this before. This has happened incredibly fast.